Markets do not collapse because numbers fail. They collapse when human behavior slowly reaches its psychological limit. Every major crash begins quietly, long before charts turn red, and long before panic becomes visible to everyone. The first fracture never appears on screens or balance sheets. It forms silently inside the collective mind. Confidence erodes gradually, replaced by hesitation, doubt, and a growing sense that stability cannot be trusted. Empires have always believed they could manage risk through systems, rules, safeguards, and complex financial structures. But risk was never the real danger inside markets, because risk can be measured, priced, and managed. Emotion was the danger, because emotion does not obey models, projections, or historical averages. Panic does not arrive suddenly. It accumulates through countless small decisions made under uncertainty. This invisible force has shaped every collapse in history. It is called the fear index. Long before prices fall, confidence begins to fracture in subtle ways that no model, indicator, or forecast is designed to detect. This breakdown does not happen suddenly or violently. It unfolds slowly, quietly, almost invisibly, without triggering immediate concern. Trust weakens first in private conversations, not in markets, far from charts, balance sheets, and official economic reports. Whispers spread faster than verified information because fear travels easily where certainty and clarity are absent. A doubt here, a rumor there, nothing measurable, nothing precise, nothing that activates alarms inside formal systems. Yet something essential begins to decay beneath the surface of apparent stability and routine normality. Belief in order, belief in control, belief that institutions and safeguards will continue to hold. Markets may function on numbers, data, and transactions, but they survive on shared confidence and collective belief. And when that belief weakens, collapse is no longer a question of if it will happen, but only when. This pattern is not modern, and it is not unique to financial markets or digital economies shaped by technology. It existed long before charts, exchanges, or algorithms, embedded deeply in the rise and fall of ancient empires. In Rome, collapse did not begin with invasion or catastrophe, but with declining trust in currency, institutions, and authority. Citizens slowly stopped believing in promises issued by power, and merchants began demanding metal instead of words. Fear did not announce itself through chaos or visible panic. It entered daily decisions quietly and persistently. People hoarded resources, delayed exchanges, avoided risk, and protected themselves from imagined future shortages. Trade slowed, optimism faded, and cooperation was gradually replaced by caution and self-preservation. No law reversed this shift, because fear had already altered behavior at every level of society. And once behavior changes, collapse follows, not suddenly or dramatically, but inevitably. Fear spreads faster than facts, because it does not wait for confirmation, evidence, or institutional approval to move. Facts must travel through reports, experts, committees, procedures, and delayed reactions before they are accepted. Fear moves directly between individuals, without permission, without filters, and without any form of friction. A single image can outweigh thousands of pages of analysis, context, historical data, and carefully written explanations. A single bank run can erase years of accumulated confidence, trust, and perceived financial stability. Logic speaks slowly, carefully, and often too late to influence collective behavior once panic has begun. Fear speaks urgently, demands immediate action, and punishes hesitation without offering clarity. When fear dominates perception, rational decision-making becomes impossible to sustain for long. And once markets respond to fear instead of facts, collapse accelerates without any external force. Modern systems present themselves as sophisticated, protected by algorithms, safeguards, regulations, and multiple layers of institutional control. They rely on stress tests, risk models, forecasts, and simulations designed to anticipate extreme but measurable scenarios. But these tools only measure behavior under stable assumptions, not under fear, uncertainty, or psychological stress. They assume rational actors, stable incentives, predictable reactions, and orderly responses to mounting pressure. When panic begins, those assumptions collapse almost immediately and without warning. Humans do not behave rationally when they feel threatened, exposed, or uncertain about the future. Instinct overrides calculation. Emotion replaces logic, and survival takes priority over optimization. Models fail not because they are poorly designed, but because fear exists outside their mathematical logic. And once fear enters the system, control becomes an illusion rather than an actual function. Fear does not move randomly. It follows a predictable feedback loop once it enters a financial system and begins to influence behavior. A small decline creates anxiety, even when fundamentals remain stable and no structural damage is visible to observers. That anxiety leads to defensive decisions, selling not to profit, but to reduce exposure and personal risk. Those actions become signals for others who are watching closely and searching for confirmation of their own concerns. Confirmation spreads faster than explanation because fear requires less certainty and less evidence than reason. Each response amplifies the next, transforming individual caution into collective momentum that feeds on itself. At this stage, fear no longer reacts to new information. It reacts only to its own previous movement. No authority can stop the loop once it is fully in motion, because intervention increases attention and suspicion. And when fear feels like survival, logic becomes irrelevant to human behavior. After every collapse, experts search for a trigger, a moment, or a single event to explain what happened. They examine charts, timelines, policy decisions, and data points, looking for a clear and technical cause. But the cause was never hidden. It was simply dismissed as irrational and therefore irrelevant. Fear is treated as noise, something to be ignored rather than measured, modeled, or integrated. So it is excluded from planning, forecasting, stress tests, and institutional preparation. By the time fear becomes visible, it is already dominant, self-reinforcing, and deeply embedded. Markets do not fail suddenly. They endure long periods of psychological strain beneath apparent stability. Pressure builds quietly, hidden behind routine behavior, normal headlines, and controlled messaging. And when the system finally breaks, it feels unexpected only to those who ignored fear. Once fear dominates behavior, markets stop responding to fundamentals, corrections, or stabilizing signals. Prices no longer reflect value or long-term expectations. They reflect urgency, protection, and survival instincts. At this stage, information loses its stabilizing function and becomes fuel for rapid reaction. Every movement is interpreted as confirmation, regardless of context, scale, or rational explanation. Attempts to reassure are perceived as weakness, delay, or evidence of hidden danger. Institutions speak, issue statements, and provide data, but their words arrive after trust has already fractured. Liquidity dries up not because assets disappear, but because confidence silently withdraws. Participants stop asking what something is worth and ask only if it will still exist tomorrow. And when survival replaces valuation, collapse becomes a mechanical and predictable outcome. Every generation believes it is different, smarter, faster, and better informed than those that came before it in history. New tools, new data, and new technology create the comforting illusion of immunity from failures experienced by previous eras. Markets appear more sophisticated, more connected, and more transparent than at any point in recorded history. Complex systems give the impression that uncertainty has been reduced, controlled, managed, or permanently eliminated. But fear has not evolved alongside finance, markets, or information systems, and it remains unchanged. The same instincts that ruled ancient traders still govern modern decision-making when pressure increases. Confidence and panic follow biological patterns rooted in survival, not in logic or technological progress. Speed changes the scale of reaction, compressing time, but not the nature of human behavior itself. And as long as human behavior remains unchanged, collapse will repeat in every era.
Markets are not machines. They are reflections of collective human behavior and shared emotional states. They rise when confidence dominates perception and future outcomes feel stable, predictable, and controllable. They fall when uncertainty replaces trust and survival becomes the primary concern in decision-making. The fear index is never published, measured, or officially acknowledged by institutions or authorities. Yet it always reaches its peak just before collapse becomes visible to the broader public. By the time numbers confirm the damage, the psychological failure has already taken place. Empires do not fail financially first. They fail mentally, emotionally, and behaviorally. Once belief fractures, systems follow, regardless of size, power, or technological complexity. And this pattern repeats endlessly because human behavior itself remains unchanged.